Hello everyone, welcome to EduTap and welcome to Finance 360-degree session. In today's session, we are going to discuss two very important articles. The first one is a notification of the Reserve Bank of India that we are going to discuss, that which is this external credit assessment institution that has been selected to give the ratings for the banks, why it has been selected and how it is going to help the banks. Okay, so this is the first news article that we are going to discuss, and we will discuss the risk weights that have been assigned for the different ratings given by this institution. Okay, so what are the different rates, that also we have to discuss. The next news article is regarding the CBDT that has raised the cost inflation index. So what is this cost inflation index, how is it used, what are the changes that has happened, and what is the index that has been notified. So all of this we are going to discuss in today's session. So good morning everyone, welcome to the session, and today we are going to discuss these two articles. The first is the notification of the RBI and the second news article is a very important finance current affair. Okay, so give me a thumbs up if I am clearly audible and visible and everything is fine. So now before starting with the articles, first let's do subscribe to the YouTube channel of EduTap so that you continue getting the relevant videos, the relevant material, and join our Telegram channel where you will get the PDF of the session, and the link for the Telegram channel is provided in the description box below. Okay, so join our Telegram channel, join the Telegram channel of EduTap so that you can get the PDF in the Telegram channel. Okay, so let's get started with the first news article that is regarding the banks can now use the ratings of CareEdge Global IFSC Limited for risk weighing their claims on non-resident corporates. So first of all, try to understand that the banks, they give loans to different corporates, to different entities. They are giving loans to the infrastructure companies, they are giving loans to the automobile companies, they are giving loans to the telecommunication companies, they are giving loans for the semiconductor companies or various kind of companies that are present in the country. Okay, so banks are giving loans to various entities, to various corporates, to various companies and such. So when the banks are giving the loans to different entities, the risk weight is attached with the loan. There is some risk that is attached with the loan. If a corporate is a very healthy corporate, has healthy financials, has healthy financial rates, and the corporate is profit making, or the corporate has a very good credit rating, so you can understand that that company has a higher credit rating as compared to the other company that has like not so good financial condition, or the company is making losses from past few years and the company has not very good relations or has not very good connections with the other banks, where the company has made like some repayment defaults and such. Okay, so that company will have lower credit rating, and with the lower credit rating there will be higher risk that is attached with this company, while there is lower risk that is attached with the good company. Okay, so this is the idea that the banks, they give loans or they have exposure, or they are investing in various companies, in various types of different companies, in various type of different entities in the countries. Now these different entities, they have different credit rating, and on the basis of different credit rating, these companies have different risk weight. Let's say this is a very healthy company, so it has a risk weight of 10%. That means it only has a risk of 30%. Let's say the other company that is not very healthy, it has a risk of 50%. Okay, now a company that is like in a very bad situation, but the loan is demanded and the company is able to give the collateral, so this company that is in a bad condition has a risk weight of 100%. or let's say 90%. So you can understand that the different entities have different risk weight on the basis of their condition, on the basis of their financial ratios, on the basis of their credit rating. These companies have different risk weight. Now, on the basis of the credit rating, the risk weight is somehow decided. Okay, if the credit rating is high for an entity, the risk weight will be low, because this is a good company that has a good credit rating, while a company that has lower credit rating, will have a higher risk weight. Okay, so the banks decide the risk weight on the basis of the credit rating also. Now, who gives the credit rating to the banks? So there are credit rating agencies that are approved by the Reserve Bank of India. They give the credit rating to the banks. Okay, so recently what has happened that the banks can now use the ratings of CareEdge Global IFSC. So you can understand that this CareEdge Global Limited, this is present in the IFSC. This is present in IFSC. Now, where is the IFSC in our country? IFSC is the International Financial Service Center. So, where there is only one IFSC in our country, where is it? It is in Gujarat. It is in Gift City. It is in Gift City. Okay. That is Gujarat International Finance Tech City. So, in the Gift City, we have the IFSC, and in the IFSC there is the Care Edge Global IFSC Limited. Okay, that is, this institution is established in the IFSC of our country, in the International Finance Service, in the International Financial Service Center in our country in Gujarat. Okay, so banks can now use the ratings of Care Edge Global IFSC Limited for risk weighing their claims on non-resident corporates operating at International Financial Service Center. So the Care Edge Global IFSC Limited, it provides the credit ratings to the institutions, and it provides the credit ratings to the non-resident corporates, that are the corporate, or that are the companies that are not resident. That means they are foreign companies. They are foreign companies that are operating, or that are originating, or that are working at the IFSC. So IFSC is the International Financial Service Center. Okay, so Care Edge Global IFSC, it provides the credit rating to the non-resident corporates, that is the foreign companies originating at the IFSC. Now the banks can use the credit rating given by the Care Edge Global IFSC for these non-resident corporates. Okay, we will discuss more about this in the coming slide. So this is the notification that is released by the Reserve Bank of India, that the external credit assessment institution, that is Care Edge Global IFSC Limited, has become a external credit assessment institution that can assess the companies, that can assess the corporates, and can provide the credit rating. Okay, now this is for all the scheduled commercial bank, including the small finance bank, but excluding the local area banks, payment bank, and regional rural banks. That is, this notification, that is the usage of the rating given by the Care Edge Global IFSC. This kind of credit rating can be used by the scheduled commercial bank, including the small finance bank. Okay, now the external credit assessment. So which are the other institutions that have been approved by the Reserve Bank of India previously? So remember that the Reserve Bank has undertaken the detailed process of identifying the eligible credit rating agencies. So RBI approves the credit rating agencies that can provide the credit rating to the banks in the country, so that the banks are taking the credit rating only from the authorized institutions, only from the good institutions. Okay, so now on the basis of the credit rating, the banks decide their risk weight. Okay, risk weight of the claim will be based on this rating, on this credit rating. So the banks decide their risk weight on the basis of the credit rating that is given by different credit rating agencies approved by the Reserve Bank of India. So domestic credit rating agencies that is approved by the Reserve Bank of India are these. And there are certain international credit rating agencies that are approved by the Reserve Bank of India, that is Fitch, Moody's, and Standard and Poor's. Okay, so these are the three international credit rating agencies that were till now approved by the Reserve Bank of India to provide the rating to the banks for different kind of claims. Okay, so this is the idea. So now what has happened, that the banks are permitted to use the ratings of three international credit rating agencies, that is your Fitch, Moody's, and Standard and Poor's, for the particular purpose of risk weighing, the claims, the loans on different foreign entities for capital adequacy purpose. Now remember this, that there is a capital to risk weighted asset ratio, that is against the assets that are risk weighted. Now what are the assets for the banks? The loans are the asset for the bank, because the bank is giving the loan, and against the loan the bank is getting the returns, the bank is getting the interest. So loans are the asset for the bank. The loans are the asset for the banks. So loans are risk weighted. With the loans there is a risk weight that is attached. With certain loans the risk weight is 30%, 50%, 70%, 90% and such. Okay, so there is risk weighted assets. Against the risk weighted assets the bank has to keep the capital. The bank has to keep the capital. That is the capital to risk weighted asset ratio. Against the risk weighted assets the bank has to keep the adequate capital, so that if the risk solidifies, the bank has enough of the capital to handle the distress, to handle the solidified risk. Okay, so for the purpose of risk weighing their claims on different foreign entities, that is the bank is giving the loan, or the bank has exposure to different foreign entities, and to have the risk weight on these claims on these exposure on the different foreign entities, the ratings can be used by the banks of these three credit rating agencies for the capital adequacy purposes. Okay, so banks can use the credit rating agencies, these three international credit rating agencies ratings, for identifying or for establishing the risk weight for their claims on different foreign entities. This is the basic idea. Okay, so if I say in Hindi, तो बेसिकली तीन इंटरनेशनल क्रेडिट रेटिंग एजेंसीज हैं. इन तीन इंटरनेशनल क्रेडिट रेटिंग एजेंसीज जो भी क्रेडिट रेटिंग प्रोवाइड करेंगी उसके हिसाब से जो है रिस्क वेट डिसाइड किया जाता है कि कितना रिस्क वेट होगा लोन्स पर या एक्सपोजर पर जो कि डिफरेंट फॉरेन एंटिटीज का जो बैंक जो है एक्सपोजर कर रही है इन डिफरेंट फॉरेन एंटिटीज पर. ओके, सो बैंक जो है कनेक्टेड है या बैंक जो है बहुत ज़्यादा एक्सपोजर करती है, लोन देती है, इन्वेस्टमेंट करती है अलग अलग फॉरेन एंटिटीज पर, तो उस एक्सपोजर के या उस लोन का कितना रिस्क वेट होगा वो डिपेंड करता है कि कितना क्रेडिट रेटिंग दी गई है इंटरनेशनल क्रेडिट रेटिंग एजेंसीज ने. ओके, सो दिस इज द जिस्ट ऑफ द आइडिया. ओके, now it has been decided to permit banks to also use the rating of CareEdge Global IFSC Limited for risk weighing their claims. So basically now it has been permitted by the Reserve Bank of India that the banks can use the ratings given by the CareEdge Global IFSC Limited for risk weighing their claims, for risk weighing the claims of the banks, for having the risk weight on the loans on the exposure of the bank on non-resident corporates. This is particularly for the non-resident corporates, that is basically if the bank is giving, so here you can see if a non-resident corporate, that is a non-resident company, that is a foreign company that is established in IFSC, that is working through the IFSC. So if a non-resident corporate at the IFSC is given the rating by the CareEdge, so CareEdge has given the rating to this foreign company that is established in the IFSC. Now this credit rating can be used by the bank to have the risk weight of the loan that is given to this foreign company. So this is the basic idea. Okay, so it has been decided to permit banks to also use the ratings of the CareEdge Global IFSC for risk weighing the loans or the exposure that is done or that is happening for the non-resident corporates. That is the bank's exposures, that is the loans or the investment can be risk weighted on the basis of the ratings given by the CareEdge Global IFSC. Okay, this is the idea. Now this non-resident corporate should be in the IFSC. Then only the CareEdge Global IFSC can give the credit rating for the banks to be using it. Okay, now if the credit rating is given AA, that will have the risk weight of 20%. So the rating risk weight mapping for the ratings assigned by the CareEdge Global IFSC Limited shall be as follows. So basically with the credit rating there is the risk weight. So if the credit rating is AA, the risk weight should be at least 20%. If the credit rating is AA, the risk weight is 30%. If the credit rating is A, the risk weight is 50%. If the credit rating is BBB, risk weight is 100%. If the credit rating is BB and below, the risk weight is 150. So if a non-resident corporate at the IFSC is rated AA by the CareEdge Global IFSC and the bank has the exposure to this company, if the bank has given the loan to this company or has given the investment to this company, so the bank will apply a 30% risk weight on the exposure, on the loan, on the investment and such. Okay, so according to the AA rating, the risk weight will be 30% on the exposure of the bank. This is the idea. Okay, now this is the complete idea about the notification of the Reserve Bank of India. If there is any confusion, kindly ask me, but I hope this is very much clear that the banks can use the ratings given by the CareEdge Global IFSC, but the CareEdge Global IFSC can give the ratings to be used by the bank only for the non-resident corporates that are originating at IFSC, and the banks can use these ratings for having the risk weight, on their exposure, on their loan or the investment. Okay, now coming to the next news article, that is regarding cost inflation index. So basically try to understand that in 2010-11 in this financial year you invested 10 lakh on a property. Okay, now you are selling the property in 2025-26 in this financial year, you are selling the property at 50 lakh. You are selling the property at 50 lakh. So what will be the profit? So you might think that your profit is how much? 40 lakh. 40 lakh is the profit. But can you buy the same products with the 50 lakh that you could have bought in 2010-2011? Can you buy the same product, or can you buy the products from 50 lakh that you bought in 2010 and 2011? So can you do so? Can we buy the same products like with the 50 lakh in 2025, 26 that we could have bought in 2010, 2011? No, right? There is some inflation that has happened from 2010 to 2025. So there is some inflation that has happened because of the inflation. The prices have risen, and now you cannot buy the same products of 50 lakhs that you could have bought in 2010, 2011. So that means the profit, the actual profit, the real profit is not 40 lakh, because this is not in the real terms. If we see in the real terms, the profit is not 40 lakh because you cannot buy the same products with the 50 lakh in 2025, 26 that you could have bought in 2010, 2011. So how can we say that 40 lakh is the profit when you cannot buy the same products now with the money that you could have bought in 2010, 2011? So in the real terms, the profit is not 40 lakh. In the real terms, the profit is not 40 lakh. And so if you are giving the tax on 40 lakh, that does not make sense because you are giving tax on inflated value. You are giving tax on inflation. So yes. So the idea is that there is the cost inflation index that is calculated to calculate the inflation adjusted value of the purchase or the inflation adjusted value of the property, okay? Because there is inflation that has happened, because of the inflation, the property value has inflated. So what is the idea? That let's say you bought a property in 2010, 2011 at a very secluded area for the investment purpose, okay? Now this is the secluded area where you have the property, and there was no shops, no, like it was a like jungle area, forest area, and you bought the property there. Now what has happened that from 2010, 2011 to 2025, 26, there is the settlement that has started to happen there. The buildings have started to build, there is DMart that has opened nearby, or there is mall that has opened nearby, and now the property prices is increasing because of the increase in inherent value of property, because the property is demanded. Okay, the property value has increased because of the facilities that are being provided nearby. So this is the actual increase in the value of property because of the increase in inherent value. So this is the idea that the property's value is increasing because of the inherent value of the property. But because of inflation also, the property's value has increased. Because of inflation also, the property's value has increased. So now if the property is selling for 50 lakh, you can understand that it includes this higher value, it includes the inflated value as well as the inherent value of the property. So the profit, so we have to see that how much profit the person has gained on the actual investment, on the actual inherent value, excluding the inflation, because inflation has increased the value of everything. And now in the real terms, we want to see that what is the increase in inherent value of the property. And the tax will be taken, or the tax should be taken on the inherent value of the property and the gain from the inherent value of the property. So this is the cost inflation index, that is an index used to adjust the purchase price of long-term capital asset, okay? So the property, you can understand, see, long-term capital gain is usually the capital gain that is from something that you are holding for more than 2 years, okay? So if you are holding the property or land or house for more than 2 years, so whatever gain you are getting, whatever profit you are getting after 2 years, so that is long-term capital gain, okay? So this cost inflation index, this is an index that is used to adjust the purchase price of the long-term capital gain, so that we can actually see the inherent value of the property and the gain from the inherent value of the property after deducting or after adjusting for the inflation, okay? I will give you a numerical example so that you have the clarity here. But the CBDT, that is Central Board of Direct Taxes, has revised a key metric used to calculate inflation adjusted purchase price of asset. So we are basically adjusting the purchase price for the inflation. Let's take an example so that you have a better clarity. So here, first of all, what has happened that the cost inflation index, its value has increased from 363 in 2024-25 to 376 for 2025-26. So the index value, cost inflation index, because the inflation is increasing, the cost inflation is also increasing, and with that the index, the cost inflation index has increased from 366 to 376. Now let's take a numerical example. So here, let's say you bought a property in 2010-2011 for 10 lakh rupees. Now at the time of 2010-2011, the cost inflation index was 167, right? It was 167. Okay, so cost inflation index was 167 in 2010-2011. Now, so you sold the property in 2025-26 and now the cost inflation index in the current year, the cost inflation index is 376. 376. That means inflation has increased. You can see that the cost inflation index has increased. That means inflation has increased. Now, this is the price of the property that you purchased in 2010-2011. Now, what is the indexed price, or what is the indexed cost of acquisition? So here we are taking the purchase price and we are seeing that in the current time, what would have been the purchase price of that property that is in a forest area. Okay, so here cost of acquisition, the cost of acquisition in 2010-2011 was 10 lakh rupees multiplied by cost inflation index of transfer year. That means the current year, what is the cost inflation index, in which year the property is being sold. So the property is being sold in 2025-26 and the index is 376. When the property was acquired in 2010-2011, what was the CII, what was the cost inflation index? It was 167. So here the value is the adjusted value of the property. We can say the indexed cost of acquisition or the adjusted value of the property is 22.51 lakh rupees. That means in the current period, if you are going to the forest area and you are purchasing the land in the current period, you are going to buy it at 22.51 lakh. So in 2010-2011, you bought it for 10 lakh. Now it has the same value in 2025-26. It is adjusted for inflation, and after adjusting for inflation, now the property would have the price in the forest area to be 22.51 lakh. Now it has converted, the property has converted from being in the forest area to being in the developed area. So that's why you are selling the property for 50 lakh. So the actual profit that has happened because of the inherent value of the property, as now it is in the established domain. So now the inherent value of the property has increased from 22.51 to 50 lakhs. So the actual profit because of the investment that you have done is around 27 lakhs. Any confusion here? 27.49 lakh. Okay. So the rationale is that the long-term capital gain on the asset such as land and buildings should apply only on the real term profits or the real profits. Okay. The purchase price, that the property that we have purchased in 2010, the purchase price has to be adjusted for the inflation, and that is what we have done. We have adjusted the purchase price for the inflation. Okay. This is the idea. After adjusting the purchase price for the inflation, then we can take out the real capital gain. Okay. So the capital gain is calculated by taking the current sale price. So current sale price is 50 lakh minus the indexed purchase price or the actual purchase price after adjusting for inflation. Okay. So that is 22.51 lakh. So the tax will be taken on 27.49 lakh. Okay. So before, if we see, the 10 lakh was the purchase price and 50 lakh was the selling price. So it would have said that 40 lakh, this is the profit. So the tax will be applied on the 40 lakh. No, we are adjusting this purchase price for the inflation, and now the purchase price is 22.51 lakh and the sale price is 50 lakh. So the actual profit is, the real profit is 27.49 lakh. So the tax will apply on 27.49 lakh and not 40 lakh. This is the idea. This is the idea of cost inflation index, that Central Board of Direct Taxes has revised the key metric used to calculate inflation adjusted purchase price of the asset, enabling sellers to claim greater tax relief on the assets. Okay. So official notification of the CBDT showed that the cost inflation index used to neutralize the impact of inflation on asset prices has been raised to 376 from the earlier 363. So basically the index value has been increased from 366 to 376. This is what you have to remember. For all the years, the cost inflation index was given. I have not taken all the years here because it would have been a very long table that you won't have been able to remember also. So just remember these two numbers here. And the base year is 2001-2002. Remember this also, that the base year is 2001-2002. Okay. For this cost inflation index, for any index, the base year is very important. Now coming to the next question, next point, that is a higher index boost. The higher index, that is the index has been increased from 363 to 376. The higher index boosts the inflation adjusted purchase price of an asset, thereby reducing the taxable capital gains. Okay, with the inflation, this purchased price value will be boosted, due to which there will be less profit, so there will be less tax that has to be given. Okay, so if the purchase value is increasing, there will be lower profits. With lower profits, there will be less tax that had to be given. Okay, so capital gain is calculated as the difference between the sale price and the indexed purchase price or the adjusted purchase price. Okay, this is the idea. Now, revised index applies to the current. This is important, that the revised index applies to the current financial year, that is financial year 2025-26, and the corresponding assessment year, that is 2026-27 and beyond. So, assessment year refers to the period in which the income is earned during the previous financial year. So, if you are filling the income tax returns now, this year is the financial year in which you are doing the earnings, and the assessment year is the next year. Like the people that have earned the income from April 2024 till March 2025, they will fix their income tax returns in the June-July month now. So, in the financial year, that is, so basically, if you have earned the income in April 2024 till March 2025, you are filling your income tax returns. You are filling your ITR in the June, July, August, these months of 2025. That is in the financial year of, this is the assessment year, sorry, this is the assessment year of 2025-26. So, if you have earned the income in financial year 2024-25, you are filling your ITR in the assessment year of 2025-26. That is the next year. So, if your financial year, the current financial year is 2025-26, the assessment year in which you will fill your income tax returns and the returns you will be filling will be the 2026-27. So, the assessment year refers to the period in which income earned during the previous financial year is assessed and the tax returns are filed. So, I hope this much is clear, that the tax returns are always filed in the next financial year, that is known as the assessment year. So, if you have earned the income or profits or interest in this financial year 2024-25, so you will be filling the returns in the 2025-26. Okay, that is the assessment year. Now, however, the scope of, now the important point is, another important point in this directions is that the scope of indexation benefits has been narrowed. That means before the indexation benefits were given to different institutions, entities and such, and the indexation benefits were provided in a broader manner. But now the indexation benefits are being provided in a narrower manner. How is it so? That we will understand. Now, the Finance Act of 2024 restructured the capital gain tax provisions as part of the government's broader push to simplify the tax system. So, there were major changes that were brought in the tax system, and to simplify the tax system, there are changes that has happened in the cost inflation index and the calculation of the long-term capital gain also. So, under the new rules, indexation benefits are broadly available for assets sold before 23 July 2024. You can understand that if you are selling your asset, if you are selling your property, house, after 23 July 2024, you will not get the benefit of indexation. So, all this that we have understood, that you have to pay lesser tax because the real profit is less, so you have to pay lesser tax. So, this benefit will not be provided for the property that is sold after 23 July 2024. So, basically, indexation benefits are broadly available for assets sold before 23 July 2024. Now, the benefit here is provided, or the relaxation here is provided to the people like you and me. So, a grandfathering clause allows resident individuals, that is like people like you and me, we are the resident individuals, and the Hindu undivided families to continue claiming the indexation. So, basically, the indexation benefits have been removed for the property that is sold after 23 July 2024. But remember that for the resident individuals and Hindu undivided families, this indexation benefits will continue even on sales made after 23 July 2024 if the property was purchased before 23 July 2024. That means if you have purchased the property in 2022 and you are selling the property in 2025, you will get the indexation benefit. If you are a resident individual or Hindu undivided family, if you belong to the Hindu undivided family, then you will get the indexation benefit even if you are doing the sale after July 23, 2024 if your purchase was before July 23, 2024. Okay. For all the other entities, for the non-resident Indians, for the companies, for the limited liability partnerships, you can understand that this benefit is not available now. The indexation benefit is not available because for any asset that they have sold after 2024, July 2024, 23rd July 2024. Okay. So for the non-resident Indians, for the companies, for the limited liability partnerships, if they are selling the property after 23 July 2024, the indexation benefit is not provided. But in our case, in the case of resident individuals, Hindu undivided family, if we are selling the property after 2025, after 2024, also, let's say in 2025, 2026, indexation benefit will be provided if the property was purchased before July 2024. Okay, this is the idea. Now, in such cases where we are getting the indexation benefit, there are two things that we have to keep in mind. Okay, so what are the two things that we have to keep in mind? First of all, for the resident individuals and Hindu undivided family that are getting this indexation benefits, it is not without some clauses. So we have to follow some clauses. If we have purchased the property, the date of property purchase is before July 23, 2024 and the date of sale or transfer is after July 23, 2024, we are going to get the indexation benefit. But if we are getting the indexation benefit, we have to pay 20% of the long-term capital gain. Okay. So with indexation benefit, we have to pay 20% of the LDCG. In case we are not taking the indexation benefit, so without the indexation benefit, we can pay the lower tax of 12.5%. So you can understand that it has been made a little more complicated. So it is like the same thing, that old rules or the old taxation regime is there and the new taxation regime is there. In the old taxation regime, you can take some relaxations and you have to give a higher percentage. In the new tax regime, you will not get any relaxation as such. Other than that one relaxation, you are not getting any other relaxations. House rent allowance and such, you are not getting the relaxation, but you have to pay some lesser percentage of tax. Similarly, in this case also, the resident individuals and Hindu undivided families, they can take the benefit of the indexation. They can take the indexation benefit, but they will have to pay 20% of long-term capital gain tax. In case they are not taking the indexation benefit, they can pay 12.5% of indexation. They can pay 12.5% of long-term capital gain taxation. Okay, whichever is lower. Maybe some people are still paying the tax in old tax regime, some people are paying in new tax regime. Similarly, you will have to see that where you are making more benefit in the through the indexation process or without the indexation process. Okay, that is, it has been seen that you have to see that lower of tax, where you are paying lower of tax at the rate 12.5% without indexation or 20% with indexation. So wherever you are thinking that you have overall less tax, you can like adopt that process. Okay. Now, for the other people, for any other people, like if you are for the resident individuals or for Hindu undivided family, if they have got the property after, if they have purchased the property after July 23, 2024 and they are selling the property after July 23, 2024, because of course they purchased the property after July 23, 2024, so they are going to sell it after it only now. So they will not get the indexation benefit, and there without indexation benefits they will have to pay the LTCG 12.5%. Okay, any confusion here? Any confusion here? So this is the whole gist, this is the whole idea. I will provide you the questions now, but I hope you have understood this. So for the non-resident Indians, the companies, limited liability partnerships, they are not at all getting any option. They have to pay the long-term capital gain without the indexation, but with the resident individuals and Hindu undivided families, they have the option to take the indexation benefits and pay 20% of LTCG, or they can take without indexation benefits and they can pay the tax of 12.5% on LTCG. Okay, long-term capital gain. So this is the idea. Now, this is the first question. Before seeing this question, let me show you that there is the perspective 360-degree series that is going on. So you can see that this is the perspective 360-degree series, and this is like this series is taken on Monday, Wednesday and Friday at 5 p.m. and this is for your descriptive answer writing. Here you can practice the answer writing as well as the hot topics, the new topics, the current topics are taken on which the question is shown to you that what kind of question can come, and then the answer is discussed with you that what you can write in the answers, what should be written in the answers, what are the important points that should be there in the answers. So that is discussed with you. Then a homework question is also given on the question. Like the homework question is also given, the descriptive question, and you can write your answer in the comment section below of this series, and the answers are evaluated free of cost if you are answering within 48 hours. So this is a very good series for your answer writing practice. Here you can get the hot topics, you can get the questions that can come in the examination, in the descriptive part of the examination. You can also get the answers, that what answers you should be writing. Okay, so this is it for today. This is the first question. Try to answer this question, and remember, Perspective 360 is on Monday, Wednesday and Friday at 5 p.m. for your answer writing practice. Now this is the first question in regards to your external credit assessment institution. The Care Edge Global IFSC Limited has been selected as a new external credit assessment institution. So you have to tell that which of the following statement is correct, that you have to find. The second question is regarding the index value. So very easy, the index value has increased to what, that you have to tell. Okay, so this is it for today. Thank you very much for joining the session, and I hope you enjoyed the session. 23rd. So basically, under the new rules, the indexation benefits are broadly available for assets sold before July 2024. So if you have sold, so basically the non-resident Indians, the companies, the limited liability partnerships, if they have sold the asset before 23 July 2024, they will also get the indexation benefit. They will also have to pay they will also get indexation benefit, and they can pay the long-term capital gain with the indexation benefit. But if they are selling the property after this date, then they will not get indexation benefit at any cost, at any case. Okay, but in the case of resident individuals and Hindu undivided family, if they have purchased the property before this date and they are selling the property after this date, then also they will get the benefit of indexation if they want to take the indexation benefit. Okay, so this is the idea. I hope this is clear. So non-resident Indians, companies, limited liability partnerships, they will not be able to get any indexation benefit if they are selling the property after 23 July 2024. Okay, but in case of resident individuals and Hindu undivided families, they will get the benefit if they are selling the property after July 2024, after July 23, 2024, they will get the profit, they will get the benefit of the indexation if they have purchased the property before this date. Got it? Okay. Thank you everyone. Thank you for joining. See you in the next session, and I hope you enjoyed today's session. Do comment down below if you have any query. Okay. So do comment down below if you have any question, any query. Thank you everyone. Thank you for joining. See you in the next session. If you still have any confusion, do not worry about it. Write it in the comment section and I will try to explain you as much as I can. Okay. Thank you everyone.